2018 started with a bang on Hong Kong's stock market. An all-time high was hit at the end of January, followed by the opening of a new Grand Hall on the city's former trading floor. Little did investors know then that stocks here would end the year down almost 25% from their peak. Greater exposure to China's economic malaise, the trade war and tightening interest rates have all since weighed heavily on local equities.
We've seen a broad decline in almost all stocks trading here in Hong Kong. And for the larger cap stocks, such as Tencent, Sunny Optical, many familiar technological innovators, people will have a very large part of their portfolio holdings in these stocks. They get smashed as well.
Things look very different in April as Hong Kong Exchanges and Clearing welcomed new chairman Laura Cha. Her primary piece of business was overseeing the launch of a big change in local listing rules. The reforms were aimed at attracting new companies to the Hong Kong Stock Exchange. Beijing-based Xiaomi was one of the first to take advantage. The company raised almost $5 billion in the world's biggest technology listing in 4 years. But the company's share price subsequently fell. It ended the year down almost 20%. The rules have succeeded in attracting more companies to list in Hong Kong. The bourse has raised more money than anywhere else this year. But while the number of companies here has soared, the share prices of those listing has performed worse than any other major market in the world. For some corporate governance advocates, the risks are too big. While Hong Kong is beefing up its regulation and enforcement, it still ranks among the lowest in Asia in shareholder protections.
Usually when a market falls, the governance risk becomes clearer. You know, as they say in the old days, when the tide is out, you see who's swimming naked.
There's still plenty of risk on the horizon. How quickly the US Federal Reserve raises interest rates and what that means for the US economy will be key.
For the next 5-10 years, the growth engine could be different, drastically different from the past 10 years. Then that way, the longer the bottoming process can be, the more time for people to figure it out, to build up a portfolio of stocks for the next 5-10 years.
Stock falls this year will have been painful for many investors. With trade tensions between the US and China unlikely to let up, many may be worried about further drops. But others might see cheaper share prices, creating the biggest buying opportunities in a decade. Joel Flynn, TRT World, Hong Kong.